All right, everybody. Hey, welcome to our Note Nation Top 40 Tour as we roll into the Buckeye State again and focused on Columbus, Ohio tonight. I want to thank you guys for joining us here tonight. We've got a variety of local and national investors join us here. You can always check out our full schedule, our full slate of cities that we've hit and the remaining cities we have on our tour by going to notenationtop40.com. You can catch out all the replays there as well. Along with tonight, we'll be discussing statistics and some of the numbers behind what's going on in the current market. We'll talk about future opportunities, where to look, and how to get started with what's going on in the market out there, everybody. So if you guys don't know who I am, I'm honored to have you guys here. First and foremost, my name is Scott Carson. I am been an active real estate investor for quite a while, since 2002. I am the CEO of WeCloseNotes.com. That's where you can find out our website and all the different opportunities we have available for educational, our podcasts, and a variety of other things. I have purchased over $500 million in debt for our own portfolio in the last 12 years, and looking forward to try to match that number here in the next 12 to 24 months. I've been teaching investors how to tap into distressed real estate since 2004. I am the host of the nationally syndicated podcast, The Note Close Show, that you can download and listen to anywhere that you listen to podcasts. Like I said, I invest all across the country in over 30 markets, and I love Columbus. I think it's a great city. I love Ohio. I love the Buckeye State. Even though Austin, Texas is home, I have bought actually more in Ohio than I have here in Texas. So our mission has always been to help investors to accomplish their goals and dreams and increase their wealth through debt investing. There's such an opportunity out there right now, ladies and gentlemen. So many people have asked me, why am I spending time going through different cities across the country? It's for a couple of reasons. One, I do enjoy and love to help investors to find opportunities where others can't seem to find them. Tapping into different distressed assets. There's a whole variety of things. I do love to help people solve problems. I'm a big fan of helping borrowers and helping other people out there solve issues. I guess the problem solver is my love language, is one of the big things. I like to fix things. Now, I also do believe what's going on right now in the real estate market, this is the opportunity, not only of a decade, but of a lifetime for some people. If you weren't around as an investor 12 years ago, you missed out on a phenomenal opportunity. Obviously, hindsight is always 20. Well, looking back now, we see history repeating itself again with what's going on right now, and it's going to get bad here over the next 12 to 24 months. I was also at one point a distressed borrower myself. So I empathize with the borrowers out there that are facing foreclosure, facing eviction. I've been there, done that, not fun at all. Luckily for me, I had somebody that helped me out of the bad situation, and that's part of why I am doing this, not only to share options for people out there, but also for borrowers to stay intact, because there's nothing greater than helping someone, an individual, overcome an obstacle or a dream, an obstacle to achieve a goal or dream that they thought was once impossible. For many people, the thought of home ownership was a dream. It made that happen in the last couple of years. Now what's happened now is that a dream is turning into nightmares. They've been laid off and starting to fall behind their mortgage. I've set a big goal of myself to help over 1,000 investors in the next 12 months. I believe in such an opportunity of what's going on right now, and I'm committed to helping out a lot of people, and there'll be an opportunity if you guys are interested later on. Where are the opportunities? Ladies and gentlemen, they are everywhere out there, literally everywhere if you know where to look. And I don't care what asset class, whether it's self-storage, apartments, single-family homes, affordable housing, mobile home parks, office, hotels. There are opportunities literally everywhere out there. And if you know where to look and know how to reach out and find where others aren't looking, and honestly, here's, ladies and gentlemen, 90% of real estate investors are looking in the wrong spots these days. I hate to say that, but they are. Because the opportunity that is in front of us right now does not care what color your skin you are, how old you are, how much experience you have. It does not matter. Even if you've been a successful business owner or been a failed business owner, the opportunity is equally across the board for everybody involved. And with what's going on, the banks aren't going to care what kind of credit score you have, how much money you have in the bank for yourself. Honestly, most banks, especially phone calls I've had today and some phone calls that have been coming through the last hour and a half, reiterates that. And so whatever your goal is, we've all got different goals that we want to accomplish long-term. Obviously, a lot of people's 2020 goals have gone out the window. But whatever your goal is, maybe it's to retire on the beach drinking pina coladas. Maybe it's to spend more time with your spouse or have your spouse come home from work. Maybe it's to put your kids through school. Maybe it's to retire your parents. Maybe your parents are working still and you need to help and they deserve some time off. Maybe you're just tired of the damn staycation. It's time for a vacation somewhere fun. or maybe you want to upgrade your own properties or add more real estate to your investment portfolio. Whatever it is, ladies and gentlemen, it's a phenomenal goal. But one thing we know, it takes money. And many people, that stops people right there. Oh, I don't have enough money in my account. I don't have $1 million or $500,000 to fund the stuff of what I need. I don't have $4 million to retire. Ladies and gentlemen, yes, money makes the world go round, but there's a tremendous amount of money out there. And what we're going to be talking about tonight does not require you to have your own money or credit to maybe be able to dive into what's going on. And honestly, if you can use other people's money, as we'll talk about a little bit, you understand where the opportunities lie. Okay. So what do the national numbers say about what's going on across the country? We all know it's pretty bleak. 11.1% unemployment rate in June. That number got a little bit better to 10.2 in July. Over 50 million people have filed for unemployment, with a big chunk of them still waiting on benefits. And we all know that the bailout that they're offering up to the government is not going to be enough to solve anything. It's literally just a small Band-Aid. They expect over 52% of businesses are expected to fail. That number is extreme more in your minorities too, where they're expecting 67% of small business owned by minorities expected to fail. 1 in 10 homeowners before the pandemic, before COVID, was already struggling to stay current. Yeah, that's right. 1 out of 10 homeowners were already 30 days behind in their mortgage back at the turn of the year. Now, when you look at the numbers now, we're currently at an 8.22% national mortgage delinquency rate. What does that mean? It's basically they're 8%, 1 out of 12 borrowers is at least 90 days behind, at least 3 months behind in their mortgage. And that numbers continue to climb as this drags out. Okay. Currently, 4.2 million Americans are currently in default. That's what that means. 8.22% of Americans are really, like I said, 4.2 are currently in default, facing the start of foreclosures in a lot of places. And if you look back at the numbers of where we're at today compared with what happened 10 years ago, 12 years ago, it took us 18 months to get to 1.6 million defaults starting back in 2008. Well, we're 2.5 times that number, but in 3 times faster in 6 months versus 18 months. It's going to get worse before it gets a whole lot better out there. Banks are actually preparing for roughly somewhere around, 15 million mortgage defaults to take place here in the next few years. Now, let's look at where it is for Ohio. How does Ohio kind of fall into the things? Well, Bankrate.com has a thing that they call the Housing Hardship Index, and they actually just updated it today for the state versus it was for last month's stuff. So looking at July's Ohio, this map actually is outdated. A lot more dark blue, a very dark blue, like the whole bottom half of the United States is dark blue, with everything being on right now. Ohio ranks. Unemployment rate is 8.9%, which is good. It's below the national average. Okay, that's a good thing. The delinquency rate is 6.41, is also below the national average. That's a beautiful thing. I think it leads to a lot with homes being a lot more affordable, housing being a lot more affordable in the Midwest. Now, looking at a national rank, Ohio's right smack dab, roughly in the middle. 26 nationally when it comes to housing hardship. That's the most recent updated numbers as of today. Okay. Now, if we look at the unemployment rate, Ohio, 8.9%. That's good. It came down from 11% in July to 8.9, almost 2 points, about 20% almost. And let's look at Columbus. The numbers aren't out for some reason why Columbus doesn't have their unemployment numbers out. They should be out any day now. Cleveland's out. But I expect it to also drop down a little bit. It went from peaking at 13.7% unemployment rate in April to 11 in May to 9.9 last month. I would say, or in June, probably going to come down around, same thing, around 8.9, maybe a little bit better than that in Columbus, Ohio. Now, if you compare it to the surrounding areas, you see Columbus, 9.9, United States, 11.2, okay? Licking County, Ohio, 9.2, Fairfield, 9.1, Delaware, 7.6. Now, the county, Franklin County as a whole, is actually higher at 10.6 than the rest of the surrounding areas, even higher than Columbus, Ohio itself. The county itself is 10.6, okay? Not the greatest thing, but you can kind of see how it ranks compared to the rest. Now, if you're looking at some of the major cities and what the unemployment rates are, here's the most recent numbers. Like we said, Columbus at 9.9, Cincinnati's a flat 9%. Cleveland's at 11.7. Toledo 12.3, Dayton 10.7, and Akron 11.1. So actually Columbus is doing a better job unemployment-wise compared to the rest of the major cities in Ohio. Now looking at if people can't pay their mortgage, what happens next? Well, that leads to foreclosures. And you can see that the price point is really that 200 grand or less is the big serious default stuff across the board. Specifically less than 100 grand. It's predominantly in homes built 1950 or older, okay? And looking, it's not too bad when it comes to the number of foreclosures. Basically 1 in every 9,000 across all homes in Columbus. Now, the couple counties that are zip codes are hit a little bit harder. It's 43085 is 1 in basically every 3,500, and 43205 is 1 in every 3,700. The others aren't too bad for the most part, but those are the 2 hardest hit counties when it comes to foreclosures across the board. Okay. Now, another thing to keep in mind too is you can see the numbers are down pre-foreclosures compared to over last month, quite a bit down compared to a year ago. Auctions are up more than last month, along with bank owned. But those are ratios. If it's been just a little bit of an uptick, you can see the numbers here, number of filings. Obviously dropped off the board in February, slowed down, and definitely in May when everything really was at the lowest. It's still staying low. It's because of what Ohio is or isn't doing for its borrowers and tenants out there. Pardon me. You can see the numbers dropped off in May, started to trickle back up. You're going to see a lot more here for the month of August as we get to the end of this month. Why? I'll tell you in a second, but Columbus and Franklin County are on track, roughly the same as national average as type of the filings out there. Now, looking at the country, it's kind of a heat map of states based on the color if they did anything. Now, Ohio did no state or local moratoriums issued across the board. Now, what's happened, though, is there was an eviction moratorium for a while. And basically, each county did something different, but that's all pretty much expired. Now, looking at Franklin County, the moratorium for evictions and foreclosures ended June 1st. July 30th was Dayton Municipal Court. Montgomery County had the longest one at July 30th, but we're still a month out from that being done. Now, what happened is they're expecting hundreds of thousands of Ohioans could face evictions in a long, disastrous fall here all across the state because of what's going on. Now, a little bit, Trump did issue an executive order that you've got a government-backed loan or you're renting from somebody who has a government-backed loan on that property, your moratorium has been extended through August 31st. So that's a couple days from now. But after that, we're either going to see things get extended or it's going to start the process of things getting kind of rough here in the next couple of days, especially as we move into September, as everything's supposed to end August 31st. It's kind of, hey, back to work, you no pay, you no stay, okay? And Ohio has started back up. This is actually through July. Was already, as of middle of July, was back up to 9% of where it was before everything happened, getting back to business as usual. Now, obviously, there's talk about obviously a lot of evictions, a lot of foreclosures taking place. Are we going to see a huge tidal wave or tsunami of this stuff? And the answer to that is yes. It's going to vary by the loan type, though. When you look at the government-backed loans on single-family homes, there's a variety of categories. You've got FHA, Fannie, Freddie, conventional loans, VA loans. The hardest hit, though, that the biggest default rate across the board has been on the FHA loans. That's your first time that's sub $200,000 or $200,000 or less mortgage, where somebody needs to bring 3.5% down payment, pay the closing costs. Not really FICO based. Well, the reason it's such a big default thing is not only is that buyer really more directly related to layoffs, especially they don't usually have a lot of savings, and with what's going on in the mortgage products over the last 12 and 24 months with Bank of America and other bigger banks donating the down payment or paying the down payment and then also willing to pay closing costs, you have a large percentage, huge percentage of first-time home buyers in the FHA programs getting in with zero out of pocket. That's why you have such a big default rate. People getting in that normally wouldn't be getting into houses because they need to have some skin in the game. People don't have skin in the game, okay? When you compare that to the other conventional loans at 3.16, it's about a third. Your VA and other loans are in the middle there. But it's gotten worse. The numbers came out for through July, and that number actually increased 40%. Actually, yeah, 60% from 9.69 to 15.6% default rate on FHA loans. That's not a good sign. 1 in 6 borrowers in an FHA loan are in default. Okay. Now, yes, a lot of people are doing forbearance agreements. That number continues to fluctuate a little bit. They're saying we're somewhere, we've moved down from basically 4.6 to somewhere around 4.2, 4.1 million Americans in forbearance agreements. And that obviously the biggest thing about that is also your Fannie, your FHA, and your other types of loans. But the thing is, they say there's probably another 4 million borrowers who need to file for a forbearance agreement who haven't done that out there. Now, is this good news or bad news across the board for us? If you're a real estate investor, you got to know where to look. Now, Ohio has higher defaults than your national average, okay, or a little bit. They're right about, depending on where you're looking at in the county. Longer foreclosure timeframes are going to drag this out. Now, if you look at, I'm sorry, not Florida, Ohio. I should say Ohio. I missed that. For a FHA foreclosure, it'll take 510 days to foreclose. Now, if you've added in a 6-month forbearance agreement or the possibility that FHA and the other government loans will do a second 6-month forbearance time frame, now you're going to have a backlog of forbearance. You're going to have a backlog of foreclosures. It's not going to be as bad as 2008, 9, 10, but it's going to get pretty bad out there. And it's going to be a while before these big REO portfolios or these foreclosures literally hit the market. It's be 12 to 18 months before you see a big foreclosure wave. So what are you going to do? Sit around, twiddle your thumbs and wait around and then fight everybody else who's chasing deals? I don't think so. All right. Let's talk about the commercial debt. Commercial's debt been hit hard as well. We're seeing increased rent signs. We've seen buildings boarded up. Like we talked about, businesses going out of business or not coming back. Retail's been hit hard. One every 2 malls expected to be not coming back or failing. We've had this commercial boom going on for a while, and I've really said the last 2 years, I think it's overpriced. A lot of big guys on Wall Street agreed with me. And you've seen a big default rate. This is through June. This isn't in July's numbers, but the second quarter, as of July 10th, you can see that the lodging rate is at 27%. It's probably closer to 30 to 33% now in default rates. Retail has always been hit hard. It's about somewhere around 20% now. College housing, obviously, with Columbus and Ohio State University, it's a difficult thing, especially a lot of the universities around all of Ohio. You're going to see some student housing in default. Seeing restaurants struggling. Now, looking at kind of the area here, Cleveland in Ohio, I mean, there's the CMBS market besides the bank loans. The commercial mortgage-backed security market really has been hit hard. $50 billion in commercial value dropped basically in February and March. Cleveland's got about $550 million on CMBS loans. Columbus also has several $100 million in bad commercial mortgage-backed security loans. Now, when you look at the default numbers across the board, they're saying that closer to 1 in 4, 1 in 3 hotels are in serious default. Okay, some have been closed. Nobody's traveling. 1 in 5 retail loans, there's probably closer to 1 in 4 are in default. They're expecting us to see an increased vacancy for retail and restaurant space across the country. I think it's going to be hit harder in college towns as students aren't there. You're going to see increased vacancy in office space go up 19 to 25% across the country. You're going to see rents drop by at least 10% by year end, and that to continue into next year with another 5 to 10% decline. Now, when you have increased defaults, that means property values are dropping with foreclosures. You have lower rents. People aren't paying their rent, increased vacancies. It's not a good mixture to keep values up high in the commercial asset side of things. And what's different about this time versus last time, 10, 12 years ago? 12 years ago, it was Wall Street financing roughly about 64 to 70% of all the distressed stuff. Now, the last 2 years, 3 years, it's been banks, your traditional banks going out and financing this stuff because they're all excited. Oh, yeah, commercial's a safe way. Well, it rarely ends up working out like most people think on the cash flow side when it comes to commercial. Now, they're not financing commercial properties at 95 cents on the dollar or higher. They are financing them at 63 to 70%, being very stringent on where their risk lies above that. Now, like we said, when rents go down, vacancy increases, foreclosures increase, it drops your value. Well, if you've got a 69% LTV, you're no longer sitting at 69. You're probably at 75, if not closer to 80, depending on how long the market sits there. That's 10 to 11 to 15% over where you want to be as a bank. So what do you do as a bank? Do you start the foreclosure process? You can. You're first going to go to the borrower and say, hey, bring 10 to 15% cash to the table off of the loan so we can be back at 65% LTV. Now, who has that? Not many people do. Now, the banks have been lenient for a little while. I'm willing to stretch this out and kick the can down the road a few months, 6 months here. But at some point, the piper's got to get paid. It's definitely got to happen because of everything going on in the banks. And the banks are getting, their arteries are clogged with this stuff, okay? Now, what do you do with this stuff? Do you foreclose? What do you do with it? Well, you buy the big opportunity. Wall Street's been literally saving money and getting into this. You're seeing more and more funds coming in to gobble up debt. As you buy in, you provide capital, buy up some of these bad loans, work with the current borrowers to try to reposition the property and adjust it, or try to, keep the borrowers in there and work with them if you're buying the debt cheap enough. Now, banks are expecting to lose somewhere around $48 billion in commercial real estate loans alone. We're talking that's some of the bigger ones. It's going to be worse than that. A couple of weeks ago, Bank of America started setting aside billions of dollars. They set aside $5.1 billion just a few weeks ago because of the bad loans that have soured on their books. And it's going to get worse. It's just not B of A. It's the big guys. And you look at the big four, it's going to be worse than $48 billion. They're expecting, here's the thing. The big four have at least $151 billion of loans in deferral status at mid-year. That's not a good number to be at. They literally set aside, the four set aside $32 billion for loan losses second quarter alone. Almost a record, close to a record. Not the kind of record you want to have. But that's what I'm trying to say. If they're setting aside $32 billion in just second quarter, and we haven't seen what's going to happen yet with a thing, it's going to get worse. It's going to get a lot worse out there. When you start looking individually, 12% of Wells Fargo first liens are in deferral. 10% of their second are also in trouble. 9% of JP Morgan's residential real estate portfolio was subject to payment deferrals. That's basically 3/4 of the total $28.3 billion of consumer loans in deferral with them. Wells Fargo, 44.2. Citigroup, modified about 20 billion loans. Okay. Bank of America is during payments on 7.7 billion and 28.5 billion in consumer and small business debt. The country's on sales, ladies and gentlemen, if you don't know this. I had some very interesting conversations. It's going to get a whole lot worse before it gets a whole lot better. And the bankers I'm talking to from the East Coast to the West Coast are agreeing with me. They're very, let's just say this, open to phone calls, okay? They may not be moving a lot of stuff yet, but they realize shit's going to hit the fan here in the next 90 days. So what do the opportunities lie? Well, the opportunities lie not in foreclosures and REOs, because it's going to take you 12 to 24 months if you want to wait around for foreclosures and REO, real estate owned assets. That doesn't make any sense. Fix and flips as an investor, no, because a lot of lending programs, a lot of hard money lenders have pulled their money back and don't want to have stuff out 6 to 12 months on an unfinished project that may not pass muster when it comes to appraisals, or in a cash out refinancing at the end of that 6 to 12 months. Is it in the rental side? No, it's not in the rental side. The number of evictions going on, I don't think I want to be in the rental side. Okay. The real opportunity lies in the debt game, ladies and gentlemen. And we talk about the debt game, that's buying the mortgage, becoming the bank, but you bought it at a huge discount. And we're already starting to see opportunities out there. We're going to see a lot more residential notes portfolios hitting the bank's balance sheets to sell in the fourth quarter. Already starting to see commercial deals this quarter. And my buddies on Wall Street are already talking about that they've seen more deals in the last 2 months than they've seen in the last 24 to 36 months. A lot of opportunities if you know what to do and where to look, okay? I mean, we made phone calls today for basically 4.5, 5 hours, talked about 20 bankers, and it's been some really good conversations. Already got a couple of non-disclosure signed from some new connections, and it's just an overwhelming amount of deals. Now, the deals aren't these huge 5 million plus or 20 million plus. Really, opportunity in the commercial space is in that smaller balance, $2.5 to $5 million value, and being able to go in and buy that stuff at a discount, and then working out to be flexible with the tenants or the borrowers in some sort of fashion. Trying to repivot in a variety of ways. Maybe you're working with a borrower who, on a hotel, you pivot it from a hotel into an apartment complex. We've got our buddy Garrison Gilbert doing this in Pennsylvania and Maryland in a couple properties he's working through. You look at maybe taking office space, which has been hit hard, and converting it into self-storage facility because it's set up 10 by 10s and people need a place to store their shit. They don't want to show up to the office, but they need a place to store the stuff that they're going to leave there for a little while. Opportunities exist if you know where to look, ladies and gentlemen. Okay, and there are plenty of banks in trouble out here. Here's the thing. Ohio, as a state, has a lot of banks that call it home. I think you agree to that. There are there's thousands of lending institutions out there. And one of the things that we look at on a quarterly basis is the Bauer Financial List. And that kind of tracks the banks that are in default. It tracks all the banks with their quarterly reports that they file with the FDIC. Okay. Now, looking at Ohio, banks that call Ohio home, you've got some big banks there. Okay. There are 81 banks based in Ohio, and taking a snapshot of their home offices, and obviously they lend all across the country. But taking a look at those 81 banks that are based in Ohio, there's a combined $14.3 billion in 90 plus defaults. Okay. 14.3 billion between those 81 banks. 8 billion in additional 30 to 89 day lates that are just coming down the road that are already defaulting. So you're seeing somewhere around 22, 23 billion dollars in defaults from these 81 banks. Now you've got some bigger banks. You got 11.7 billion of that portfolio is single family homes in default. That's pretty scary. You look at on average, it's only about 4.18% average across the board of the bank's portfolios. But when you add in Chase, Fifth Third Bank, and U.S. Bank is the three biggest guys, they alone have 12.3 billion in 90 days defaults alone. Okay, yeah, they got the lion's share of that, about 80% of it. All right, that's a lot of debt across the country, not just in Ohio, but all across the country, residential and commercial out there. So why do you want to buy distressed debt? Somebody's not paying. Why would I want to buy it? Well, because the fact of a couple of things. One, if you start buying that debt now, you're going to get it at a huge discount, and it gives you a lot of flexibility to work with the homeowners. Instead of waiting around to foreclose on a property, wait for foreclosures that the banks are going to sell at the full highest value they can get. Buy the debt at significant discounts, depending on location, foreclosure time frames, values, conditions, etc. Ohio is a prime state to buy debt in, okay? You buy the debt, control the asset for huge discounts, 30 to 70% off of as-is values. And we've seen this before with Ohio. We've seen this before in other places out there. There's already, like hotel loans are already going at a huge discount, okay? Your strategies should include loan reinstatement, modification, short sales, short pass, foreclosures, loan sales, whole variety of different exit strategies you can do by buying the debt and working with the borrower of some sort. Now, if you want to, you take over the note, become the bank, and turn it into a cash flow note because you get reperforming. Or if you want to add, you can take the asset over, take the property over, allow the borrower to walk, and do what you want with it. Reposition it, pivot it, whatever. There's other advantages of note investing that I love out there too. Many investors I know are struggling to put money, put bread on the table. Sorry. And you don't have, a lot of investors don't have extra thousands of dollars each month to be mailing out postcards and yellow letters to foreclosure lists and things like that and getting a 1 to 4% response rate. We don't do direct mail postcards or letters in the debt space. We're contacting banks. If you can jump on the phone, send an email, or jump on LinkedIn, you can do this business by finding deals that feed you on a regular basis. Banks that have stuff every quarter, every month, they're looking to get rid of. And one source can lead to regular deal flow versus just, I'm going to send out postcards and I'm going to maybe get one deal, one property from that borrower. No. Do regular deal flow. Cherry pick the best deals for your portfolio. If they send you deals you don't want, hey, you don't deal with those. Now, if you want to buy in bulk, guess what? You can get even better pricing. But you don't have to have a tremendous amount of money to buy residential and commercial assets of your own funds. There's plenty of other investors out there to fund the deal, ladies and gentlemen. And Ohio has a lot of investors out there. You got to keep this in mind. 15 million homeowners were underwater across the country back in 2010. Most people that lived through that were investors that missed out on that opportunity. One of the biggest things they said they could do is go back and buy more real estate. I know that's what I would do. I'd go back and buy more. Well, now's an opportunity for you to be able to do that on residential and commercial assets, unlike we've ever seen before out there. Now, are there investors out there? Yes, there are plenty of real estate investors out there. There's over $9 trillion in retirement funds sitting out there across the country. And when you tap into what's going on in Ohio, specifically putting a microscope on the Columbus market, Columbus has a good chunk of investors out there with money. There are literally 23,000 investors in Columbus that have an IRA of some sort, an individual retirement account. That's a pretty good chunk for the size the city is. And then when you figure out that there are 15,000 of them that have at least 150 grand or more in accounts, that means even better. There's a lot of money sitting there in Columbus. How many people do you need to talk to? And it's like this all across the country. We see on average that about every city, 2/3 of the IRA investors have 150 grand or more. Now, let's say I don't want to raise capital, Scott. I don't want to do it. I just want to flip deals. Okay, I just want to wholesale deals or go find deals and flip them to other investors. Okay, great. Columbus has a bunch of investors as well, 15,000 local real estate investors in the Columbus market alone. 15,000 people that file their taxes as real estate investors. So go be a deal engineer. Go find some deals and find investors and flip it to. Put yourself in the middle and be a deal engineer out there, everybody. The question I want to ask you all is, do you want to be the banker or the borrower? Most of us are the bankers. We're paying money out on a monthly basis to our mortgage or credit cards or student loans or truck debt to Bubba Jean down the street, whatever. That's not the smart play, okay? You want to be the bank. And there is more money in savings sitting on the sidelines right now waiting for something to happen, waiting for somebody to step in. And the reason the banks are so big, guys and gals, because they understand this. They take that money, give somebody a small return on investment, 0.1%, and go out and make 6, 12, 20% of their money. You have the opportunities to leverage that too. Take somebody who's making 0% on their money and give them 3, give them 6, give them 8%, and go out and make a lot more money on it. Because, ladies and gentlemen, what you have to realize is the banks always wins. The bank always wins, everybody. That's why they're the biggest institutions out there. And you have the opportunity to step into the bank's shoes, buying assets, buying what they've originated at 30, 40, 50, 60 cents off, and being to leverage that cash flow, being able to structure some great win-win scenarios to really help the borrowers out there. So how do you tap into the tsunami, guys and gals? Well, ladies and gentlemen, I've been teaching investors since 2010. So Note Educator of the Year in 2014, runner-up to Educator of the Year in 2018. I've helped thousands of investors purchase their first non-performing note or re-performing note, whatever they're looking for. Thousands of investors buy their first note. We have closed thousands of deals over the last 10 years, and we've helped so many people really change where their life is going, whether it was buying residential or commercial notes. We've done both, all right? Whether you're looking for cash flow and you want to just cover yourself cash flow, or you're looking for asset growth, you want to add more property or more real estate to your portfolio, you can do that. You can buy one-offs or you can buy in bulk. Now, you're not going to go Bank of America, Chase the City and buy a one-off residential note. That's not going to happen. They're going to sell a portfolio of notes. They wouldn't even know how to sell one note off. But there are still plenty of other institutions out there that have plenty of their books that they're looking to get rid of, okay? And we've done trades from as little as $25,000 all the way up to $5 million. And like I said, the bank doesn't care what your credit is. They're not going to pull your credit score. You could be in forbearance on your own loan. You could have gone through a foreclosure, a divorce, whatever it is. They don't give a rat's ass whether you got a 500 or an 800 FICO, because the FICO does not mean anything to them when you're buying the debt. All they care about is that you have funds of some sort coming from somebody to fund the deal. It doesn't need to be your own, right? And like I said, you don't have to mail out thousands of postcards each week or every month trying to catch that foreclosure list and compete against everybody else. If you can jump on with an email, reach out on LinkedIn, or make phone calls like we did this afternoon for 5 hours, you can find deals and be connected to banks. And we proved that this afternoon, okay? I've been saying that for years. I don't know why I say I proved it. We've done this for the last 12 years. And I don't care, like I said, whatever your focus is, single family homes or apartments or hotels or retail office or self-storage facilities or mobile home parks, I don't care. You can really find deals in all asset classes, and you can really create some win-win stories, not only for yourself, but for the borrowers out there that are facing issues. You know, there's a lot of good people out there in Ohio and across the country. Hey, we've all been dealt a raw hand in a lot of cases where the market value drops, and who expects a pandemic to show up to lay off, 50 million Americans? Maybe you don't want to do single family homes. Maybe you want to go a little higher end. You can do that by buying it. There's plenty of this stuff that the banks aren't going to get bailed out from the government because it's high end stuff. And then maybe you want to buy in the multifamily or more commercial stuff, maybe small commercial. That's the whole thing. Small commercial has a lot of opportunity these days with what's going on in the market. So whatever your focus is, ladies and gentlemen, you can tap into it, and you can do it big or you can do it small. You can start off small like our buddy Gene Chandler was doing out of Indiana, Elkhart, Indiana, buying onesie, twosie assets here and there with what money he had. He was scared to raise capital and was interested in the note business, but didn't really know how to take it to a whole nother level. Well, we spent time with him, done a great job teaching Gene. He's gone out in the last 4 years, closed on 135 assets for his own portfolio. He started a fund, actually, and has about $3.5 to $5 million in private capital with him. And that makes a whole big difference in retirement. Having 134 deals and having over $5 million backing you to go out and buy some stuff. Hey, that's a great job. We're happy for what Gene has done. It'd be like Laura Blunk out here. Laura started off just like many real estate investors, going to local real estate clubs, trying to wholesale, trying to do some light flips, trying to learn things, sending out postcards, yellow letters, door knocking, bandit signs, anything to find a deal here in Austin, Texas. Now, Austin's a competitive market. Hey, she knew it wasn't going to be successful here, so she started tracking out the note business, learned from us, bought roughly about 16 deals in her first 18 months. Fast forward year 2, she closed on over 100 deals, most of it with other people's money, okay? And now she's getting ready to close on a portfolio of 150 performing notes at 50% of value, basically, for $4 million. That $4 million is coming from somewhere else, not her own pocket. And so we're really, really proud of what Laura's doing. You can also be like Keith Collins. Keith has done a tremendous job. He's out of Ohio. He's just outside of Cincinnati, I think in Mason, Ohio. Absolute great guy. Love talking with him. A lot of real estate experience in a variety of things. I think he builds water treatment plants. I think he was the mayor of a small town there in Ohio at some point too. Love the idea of the note business. We taught him how to buy debt, go out and modify it, and he loved it. He took to it like a bird on the wing, okay? Duck on water. I get me from him. Bought a ton of deals last year, made 7 figures last year based on what we taught him and how we taught him to go do things. And so we're really proud of Keith and what he's accomplishing at rock and roll. Now, they've all had different experience. If you're brand new to real estate and like, where do I do? What do I do? If you're coachable, you can do this business just kind of like Raphael. Raph lives in San Diego, an entrepreneur. I started a car detailing business at 15 full-time employees. Was getting bored with that, but still doing well, making good money on that, wanted to get into real estate. He learned about the note business because he didn't want to buy real estate in San Diego. He's like, it's too damn expensive here. I rent here because it's too damn expensive in San Diego. So we taught him. He's coachable. In his first 30 days after our training, he went out and bought 2 assets, and then he closed on 3 more assets just about a month later. Those 2 first ones, he used his own funds. Boom. Got them reperforming, roughly about a 20% cash and cash return. The other 2 out of the 3, he's flipping, I think doubling his money. And the 5th one, he's still working through. But unfortunately, he had to close his business. He had to basically lay all 15 employees off because nobody wants to pay to get their car detailed when they're not driving anywhere. And he's like, Scott, I want the best for my employees, my family, but I'm not going to probably reopen. And I'm okay with that because, hey, I'm prepared. I'm a real estate investor now. I've learned what to do. I've learned how to tap into this stuff, and I'm ready to rock and roll, and I'm coachable. And that's the beautiful thing. That's the thing that we love the most, is hearing success stories from our students, whether it's somebody who's brand new or somebody's got a lot of experience. If you're coachable, the note business is different than your fix and flip or your landlord base. It's not HGTV or flip this house. It's a different mentality, and you got to be coachable. But we love working with investors, and we love success stories. We love and have helped thousands and thousands of investors all across the country do amazing things and buy a ton of debt, not only and help themselves out, but do a lot of good for borrowers and people facing difficulties out there all across the United States. And how do they get started? How do they learn? If you're looking to tap into this tsunami of deal flow, the best place for you to start, I would tell you right now, guys and gals, is our 1-day Note Weekend training course. This is a 1-day online live stream that's recorded that you can catch the replays on. We do it live every 3rd or 4th Saturday of the month. We do it once a month. If you go to noteweekend.com, you can get signed up tonight and get a ton of bonuses we'll discuss, but you can see the full itinerary of what we cover. Now, this is like I said, it's a 1-day mini workshop. We run from basically 9 to 5, 9 to 6. Our students call it the Cliff Notes version of note investing. The Cliff Notes, literally. Remember the yellow book in college? You don't want to read the full thing. You jump in the Cliff Notes to get everything you need to get started, to at least understand it. That's what we're all about with this. Note Weekend's a great course to start off with. Get your feet wet. Dip your toes in the water, like we said. We just did one this last Saturday. We restreamed out, sent the replays out Sunday morning. So people that missed out or had to step away can watch everything that they missed that they couldn't attend live on Saturday. Normally it's $99. We usually run from 9 to 5, 9 to 6. You can check out the full schedule and kind of the breakdown at noteweekend.com. Our next couple classes, we have one in September, one in October. We'll probably do one in November and one in December as well. It's just become a great way for us to really help a lot of people out. Look, what do we cover? Well, the first part of the day, we cover about how to find these deals, how and where to find note deals. We'll talk about and what to say, what not to say. We'll talk about some scripts. We'll talk about different ways to build lists, how to tap into a variety of sources out there. Second part of the day, we'll talk about funding these deals with other people's money. If you don't have the money, that's great. I actually like that better because you're more coachable and you're more hungry. And we'll show you how to tap into investors not only in your county but all across the country that are looking for deals or looking to fund and get a higher return than what they're getting. The third part of the day, we'll talk about the different exit strategies, how to make money with stuff. There's a variety of different ways, not only to close on these deals, but also to work them out. Some you get reperforming, some you foreclose, and the borrower gives you the property to walk away. There's a lot of different things that go along with that, and we'll highlight each one for you. We'll also discuss the different vendors that you need to have, the team members, who needs to be a part of your team, when do you get them involved, who does what, because you're not the person that's going to be doing it all, okay? We'll also discuss some of the different loan trading platforms that you can tap and start looking at deals today. And then we'll also cover a lot more marketing, a little bit on asset protection out there. It's a one-day course, ladies and gentlemen, one day. You're not going to learn everything about the note business in one day. But like I said, it's the Cliff Notes version, all right? A lot of great information, and people really love this because we under-promise and over-deliver, especially when it comes to our classes, and we're really excited. So if you go to noteweekend.com, you can get signed up right now. All right, noteweekend.com. Live stream on Zoom on Saturday with us. Ask questions live. I stay as long as you keep asking questions. We go through 6, 7, 8, 9 hours on a Saturday, and you get the videos the next day for you. Take a couple breaks throughout the day because the mind can only absorb what they ask and withstand. All right. And I'm going to throw in some bonuses for you guys. I'm going to throw in over $1,200 in bonuses for you. Obviously, you got the class, the one-day note weekend class, which is normally $99. We're going to throw in a one-day calling banks training. That's right. We just did this today. If you missed this, we did this a few hours ago. 4 to 5 hours of yours truly calling banks and connecting with banks, showing how easy it is to reach out to bank asset managers, get on their list, talk with them, follow up, show you a system on how to connect with these guys. That's normally $49 to $59. We're throwing that in, okay? I'm going to give you the most recent quarterly Bauer financial list. This is the list that shows that we purchase every quarter that shows us who's in default, who's got what in default, whether it's residential, commercial, and then basically it's basically a cheat sheet to find banks that have stuff available for you that you can buy, right? That's normally about a $400 list. We're going to throw that in, okay? We're going to do a 30-minute one-on-one coaching call with me after the class. I charge $1,000 an hour for consulting. I want to hear from you. I want to point you in the right direction. I want to get on the phone with you. Hey, how was the class? Where are you looking to go? What are you trying to do with your note business? Let's put you in the right direction, get you off rocking and rolling for you. That's normally $500 there for a half hour with me, okay? And then if you've got a spouse, a business partner, and you want them to attend, guess what? They can attend as well, all right? And I said this before. We throw the replays in. No, you don't have to wait 6 months for the replays. You get the replays to Note Weekend the next day, okay? Go back and watch it again and again and again. You get signed up tonight. You don't have to wait till 3 weeks from now. I can send you the links to the replays we just did this last weekend, and you can start learning now so that you're more educated and off and rocking and rolling when the live class shows up here. And then we've also got an amazing Facebook group, over 900 plus members, real estate investors there. Great way to add, really people that are looking for deals, people are looking to fund deals, people are glad at all across the country to look at your properties or to look and give you bet values. That's, I could say, is a lot more than $100, but we'll just throw that down there. All that's included is over $1,200 in bonuses. And we're doing you two things. One, you get signed up and you go through the class. You're like, Scott, this is not for me. It's just not for me. I don't think I'll refund your money back. No questions asked. I'll refund your money back. If you're not going to do this business, no biggie. I don't want to waste your money. I don't want to waste my time either for you. And I don't want to waste your time. I'm going to throw in one more thing besides our guarantee. I'm going to do it even better. I'm going to cut the price in half down to $49 for all of that. That's right, $49. You get the one-day note weekend training. You get access to the replays of that. You also get our one-day calling banks training. You get the replays, the one we just did, and be able and have a seat to the next one we do next month. You get the Bauer Financial List with over 1,500 banks, and I'll show you how to tap into that to identify banks that have deals. You would spend 30 minutes with me one-on-one. You get the replays, you bring in your spouse or business partner, and then you got a network of over 900 plus note investors to help you out with this as well. Guys and gals, I don't know anybody else that packs a bigger punch than what we do, who delivers consistently more content, more information than we do. That's why I can tell you nobody does. I live, I breathe this on a daily basis. That's why I'm the one calling banks. That's why I'm the one coaching. That's why, because I know that you are needing help and somebody to guide you through. And there are banks out there that will sell you assets. I don't care what your color your skin is. I don't care what your goal is, everybody. Remember, we talked about this before. You've got a goal to retire and upgrade your retirement. Most people are scared because they don't have $4 million or $5 million retired. You don't need that. Let's buy some notes that'll help fund that deal for you. Let's fund your retirement with re-performing or non-performing notes. Let's bring home that spouse. Bring home your wife. Bring home your husband so they don't have to work in a job that they hate. Identify how much we need to do that. And we put a plan in place with buying debt to help replace their income. Hey, you want to buy some deals, some notes to fund your kids' education? We can do that. Hey, maybe you want to supplement your parents' income with notes. We can do that. Maybe you want to go on a vacation and be able to do deals from wherever you're at, from the comfort of your own home or office. Nobody wants to work on their vacation, neither do I. But what's beautiful is that our team, the servicing, the attorneys, guess what? When I travel, I might answer a Facebook message or an email or two, but that's about it. You can do this business from anywhere. I've closed deals from being here in Austin or in the middle of the Pacific or in the middle of the Atlantic, all right, with travel. It does not beat that. And if you're looking for more deals, you want to add it to your bottom line, guess what, ladies and gentlemen? United States is on sale, and you can upgrade your crib and your portfolio for a lot cheaper than what you could have done in the last 3 to 5 years. So like I said, it all takes money. You don't need your own money. We'll show you how to tap into that. We'll show you how to find investors that want to fund your deals. Heck, we even got a network of them there for you to tap into for you. So like I said, ladies and gentlemen, if you really want to tap into and make your goals and take your dreams to a whole nother level, don't care where you're at, a lot of experience or no experience, hey, you got to spend a little time becoming a note investor. Might as well start fresh. And I'd love for you guys to be a part of that 1,000 that we want to help in the next 12 months. So get signed up tonight. Go to noteweekend.com. Get signed up. $49. Get you all that information. Start learning today. Be ready for the next class, the next calling banks, and be ready to rock and make the fourth quarter the best fourth quarter you've ever had. I want to open it up now. If you have any questions, comments, concerns, good to see you guys on the call tonight. For those out here, if you're watching this on the replay, feel free to ask questions. Feel free, whether you're watching this on Facebook or on YouTube or any other places that we posted, type in your questions. We're glad to answer those. You can always schedule a phone call with me too by going to talkwithscottcarson.com or shoot me a text message by texting notes to 474747. I'm glad to get in touch with you. But guys and gals, I'd love for you to be a part of it. $49, well worth the price of admission. It's worth a lot more than that, everything we provide. Either you're going to take action or not. If you, hey, dip your toes in the water, it's a whole lot warmer in here with us than it is outside with everybody else. So we look forward to seeing you at the next Note Weekend. And go out, have a great day, great evening, great afternoon, and we'll see you all at the top, everybody.